Hello, I'm Marlene Saeed. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, the world's second largest economy is stumbling, and the alarm is sounding across the globe at China's worsening economic outlook. Also this week, BRICS has invited 6 new nations, among them major oil producers, to join its ranks. But does bigger mean better? Plus, Sri Lanka's government says the economy is on the mend. Is the worst really over for the island nation's economic crisis? It's been described as the world's factory and the engine of global growth. China's economic rise was once seen as unstoppable. Then came COVID and 3 years of strict lockdowns. Fast forward to 2023, the year the economy was expected to roar back. Instead, factories are now slowing down, consumer prices are falling, real estate is in crisis, and exports are in a slump. The grim data indicates a serious economic slowdown, so much so that the US president has described China as a ticking time bomb. Well, the rippling effects are already being felt all across the world. The Chinese government has rolled out several measures to boost domestic consumption and revive the real estate sector, including cutting interest rates. For the first time since the 2008 financial crisis, Beijing has halved the tax on stock trading in an attempt to restore investor confidence. So what is going wrong for the world's second largest economy? Consumer confidence is an important factor. Many Chinese have lost trust in the government's ability to stave off an economic downturn. They're holding back on spending and investing. Instead, they're saving their money in banks. Businesses have also lost faith. International investors are estimated to have pulled out more than $10 billion from the nation's stock market in just the past few weeks. Many analysts say the property sector is at the heart of the problem. The housing market created jobs and accounts for nearly 70% of the wealth of Chinese households. But now major developers are in deep financial trouble and homes just aren't being sold. And the real estate crisis is also draining the coffers of local governments. Regional authorities have struggled to generate income from land sales. They're reported to have accumulated estimated debts of $10 trillion. Meanwhile, the prices of goods and services are also falling on weak demand. China's consumer prices fell in July for the first time in more than 2 years, tipping the nation into deflation. On top of all that, graduates just can't find a job. Youth unemployment is so high that the government has even stopped publishing data. Joining us from Singapore is Gary Ng. He's a senior economist at Natixis and a research fellow at the Central European Institute of Asian Studies. Thank you so much for your time, sir. Is China's problem, in a nutshell, that it's still relying on its investment playbook when instead it should be trying to shift balance towards consumption?
Well, indeed, I think we have already seen some progress from, China in terms of trying to rely a bit more on consumption and rely less on investment. But the problem is that the drag from investment recently has been really too big, because if you look at what happened in the property sector, I think this is really one of the biggest problems that the country is facing right now. And of course, because of this big reliance on properties, then we start to see some spillover effect towards the government fiscal situation, and eventually also on consumer sentiment, because 70% of household assets are actually in real estate in China. So therefore, I think this has kind of kicked off a snowball effect from this weak home sales all the way towards different parts in the economy. So even though we still see consumers are willing to spend on some items such as services, tourism-related expense, and also, catering services. But this amount is simply not big enough to offset the property-driven growth and some of the big-ticket purchases, such as automobile.
OK, so how big is the problem really in China? How worried should we be? Because on the one hand, you've got the US president saying China is a ticking time bomb, but the Chinese government and authorities are saying, actually, we're on track, recovery's on track, everything's fine.
Well, I think this is really related to the expectation of China's growth. I think if we look at very early this year, the Chinese government actually set out a growth target of around 5%, which is kind of ambiguous and provides some room of maneuver. It's really about the world actually expect China to grow even faster than 6%, and therefore that expectation gap is really the reason of the differences between the sentiment within China and also versus the world, because the world has been waiting for a big massive stimulus from China on supporting growth, but it is simply not there, because even if the situation deteriorate at the current pace, it will probably still meet the around 5% growth target this year because of a low base effect. But what worries me more is not really about the growth rate this year, but about the structural problem next year. Because if we continue to see this weak confidence from investment and also from consumers, which can spin all the way from properties to consumption, then I think this is really the time that we see basically a decelerating China's growth path. It will not grow as quickly as before. And because there are also other structural problems in aging population, the youth unemployment, and especially the confidence of businesses and consumers, I think this is really why we need a stronger policy to actually support these areas in China. For now, I think things are moving, but it's probably a bit too slowly. I wouldn't say it's really a ticking time bomb, but probably there is a bit of the difference in the expectations from different, government officials or analysts out there.
So, how does China unravel this? Because a lot of these policies seem to be quite linked to Xi himself.
Yes, indeed. I think increasingly we see the policy drifting a little bit more towards the the leadership in China, rather than gathering a large amount of opinion, especially from the business perspective. But having said that, I feel that the current policy is actually way more targeted than in the past, and basically the government wants to spend the minimum resources, raise the minimal debt to actually achieve the best outcome they want to achieve. So this is why even if we look at the liquidity injection in China from the monetary policy perspective, a lot of all this credit allocation is actually quite targeted. You don't want it to be, too supportive for the property sector, but you also do not want it to fall. The government wants to direct a large part of this liquidity to some of the so-called new sectors, such as green energy, tech, and also basically different type of industrial production. But I think this also raised one question ultimately, is that does government really allocate resources better than the market? I think time will really tell on this question. But for now, I think we see a very severe pressure from the cyclical perspective. There is indeed the weakened consumer and business sentiment, especially in the private sector. This is really some of the costs that we are seeing right now before we actually see the benefit.
Okay, stay with me for a second, Gary, because China has, of course, blamed a lot of its problems on the United States. They've accused Washington of attempting to block the rise of its economy. And the Biden administration has imposed sweeping curbs on Beijing's access to advanced chip technology and equipment. All this has sparked a series of tit-for-tat measures between the two nations. Now, the Commerce Secretary, Gina Raimondo, is the latest American official to visit Beijing in an attempt to try and stabilize those relations with China. So, Gary, how much are America's trade restrictions hurting China?
Well, indeed, I think if we look at all the way from the trade war of tariff towards the latest semiconductor-related measures, actually it has been quite painful for a lot of exporters and also for the players within the chip industry. Of course, China is a big country. Even though the US has actually stepped up the tariff, it will probably hurt the export-oriented provinces more. But this wide ban actually on the semiconductor industry, and together with more and more countries, will actually pose a severe challenge to the manufacturing role, especially the high-tech manufacturing sectors in China. Because if we look at how much China actually import from the rest of the world related to semiconductor equipment and also the like completed chips, you will know that actually like it's actually already overtaken oil as China's biggest import. So therefore, it means that China will really need to step up its R&D and also the investment in terms of the technological advancement. But this is not something that it can do within one day. So therefore, I think gradually, if we continue to see this move led by the US, echoed by more countries, it's possible to see basically a polarized supply chain around the world. So we will actually see probably a non-China supply chain led by many other countries like ASEAN, India, Korea, and Japan. But on the other hand, of course, within China, I think more firms will try to climb up the tech ladder, but really depends on, ultimately whether there will be progress. If there's no progress, I think the cost can be quite painful, and then it will probably focus on the lower end technology and slowly climb up eventually.
It's interesting, isn't it? Because if China's economy implodes, of course, it's going to affect everyone else that is dependent on it. So I wonder, how do you think the US and its partners are dealing with China and their strategy? What do you make of it?
Well, I think indeed China is a very big economy, but I think for the US and the partner, there are actually two factors that they will consider. The first is even without any geopolitical tensions, the Chinese economy is supposed to slow down anyway, because if you look at the path of Japan, even though it's not totally identical, but it does share some similarities in terms of the aging population, the supply chain reshuffling towards the lower cost countries. I think all of these factors basically point to the fact that China's growth will actually decelerate anyway. It's just really about whether it will decelerate faster or slower. But if you look at other markets that actually the US is trying to support, we're talking about ASEAN, India. These are these countries that basically will grow faster than China in the next few decades, even though the size may still be smaller than China because of the lower base.
So how do you see the path the Chinese economy is on right now?
Well, I think if we look at the general growth perspective in China, I think indeed like there is a bit of pressure from the manufacturing side, and basically will be a consequence of this supply chain reshuffling that we are seeing nowadays. Especially China is actually one of the countries with the biggest share in manufacturing. So with that in mind, that can have a problem in terms of jobs and the general like a widespread spillover effect towards the rest economy. I feel that China will probably likely to grow at around 4% in the next 10 years. And of course, it's still quite a decent growth rate, but it's just if we compare to the past, it's basically the golden era may have gone.
Really good to talk to you. Gary Ng from Singapore, senior economist at Natixis and a research fellow at the Centre of European Institute of Asian Studies. Thank you. China is the dominant player in the BRICS bloc, which includes 4 other top emerging economies: Brazil, Russia, India, and South Africa. Beijing, as well as Moscow, have long pushed for expansion of the bloc. Now, in a bid to extend the group's global influence, BRICS leaders have invited 6 new countries, mainly from the Middle East, to join the club. Laura Khan has more.
In its first expansion in more than a decade, BRICS announced it will more than double the size of its club. The 5-nation alliance wrapped up its annual summit on August the 24th after announcing the new invites, a move considered a major step in expanding its influence and reach.
We have to reform global economic, financial and political, as well as the multilateral trading system, so that we can create a conducive environment for fair trade.
BRICS is an emerging market group consisting of Brazil, Russia, India, China and South Africa. They've been the main engines of global economic growth over the years. Now, 6 nations offering rich resources are invited to join by early next year. They include the Arab world's largest economy, Saudi Arabia, and the United Arab Emirates. The 2 countries are also the world's largest energy suppliers. Iran has the world's 2nd largest reserves of gas, and through its north-south corridor, it could link Russia to the Gulf region and ease trade access to Asia and Africa. Argentina can offer vast natural resources, but it's been plagued with economic turmoil. And BRICS is looking to reduce reliance on the US dollar by increasing the use of local currencies for trade. Some argue this is engineered to put the interests of the global south first, countering Western dominance represented in the G7 group. They consist of Canada, France, Germany, Italy, Japan, UK, US and the EU. So how do they compare? The 7 advanced economies account for nearly 10% of the world's population. New BRICS would account for almost 5 times that amount. And when calculated by purchasing power parity, the 11 nations bloc accounts for 37% of global GDP, while the G7 share is almost 30%. The move for expansion has been warmly welcomed by all members, and those invited have expressed keen interests. Now the question is, can BRICS really shake up the world's political and economic architecture? Laura Khan for Counting the Cost.
Joining us from London is John Harrison. He's Managing Director of Emerging Market Macro Strategy at Global Data TS Lombard. Thank you for speaking to us on the programme. John, China has long pushed to expand BRICS, despite the reluctance of other members like India and Brazil. So is this a big win for them?
Yes, I think it was expected. A lot of countries had wanted to join. I mean, it's important to remember that all 5 of the original members have to agree. So in effect, they each have a veto, and they've managed to select countries that have found agreement from the other members. So to that extent, it is a win, yes.
The new joiners do seem somewhat to be a disparate group. What does the choice of countries tell us about what the group as a whole wants to achieve?
I mean, there are some common themes. Most of them are prepared to take an anti-Western stance. Most of them are commodity exporters, and they've also tended to select the largest economies in each of the regions, with some exceptions. I mean, maybe just to run through the countries, as you say, they are quite a disparate bunch. I mean, we have Argentina, food exporter, second largest economy in South America after Brazil. Saudi Arabia and Iran, I mean, these obviously key oil producers, and China here looking to consolidate on its diplomatic success, brokering a peace deal between these two earlier in this year after years of hostility between them. We've got the UAE, that's the next largest economy in the region. It's also actually the 3rd largest export partner of India. Egypt, biggest North African economy, very close ties with Russia. Ethiopia, strategic location. I mean, it's actually the 3rd largest sub-Saharan African economy after South Africa and Nigeria, but is a recipient of quite heavy investment with China from the Belt and Road Initiative. So I think they've all found agreement from all of the 5 original members.
Right, but the more members they are, the harder it is to find common ground on things. I mean, do you think this group in particular is going to work well together?
I mean, I do think that the bigger it gets, the more difficult it will be to find consensus. I think China would obviously like to expand. There are many countries that want to join, and many that have formally applied to join, but there's no real common vision between these countries. I think they're all trying to raise their profile on the world stage. They want to receive investment from China and from others. They want to work closely with their trading partners. But beyond these kind of self-interest goals, that there isn't really a common vision, and so the bigger the group gets, the more fragile it gets potentially. In particularly countries like India and Brazil that don't want to have their weight within the group diluted, and India also, of course, has security concerns over China, so it wouldn't want to be integrated too far with Chinese institutions or Chinese-led institutions.
And what about Saudi Arabia? I mean, they say they're still considering whether to join or not. They're still on the fence. What would they get out of joining the BRICS?
Well, I mean, Saudi Arabia, of course, a major oil exporter, so it would be good to have a forum to discuss with major oil importers like China and India. Also, Saudi Arabia for many years has been trying to, with varying degrees of success, trying to diversify its economy away from oil. So investment from China could help with that effort. So I think there is a lot to gain, but of course, Saudi Arabia in particular is also an ally of the US, and even though the US is less dependent on its Saudi oil than it has been in the past, Saudi Arabia is still a recipient of US arms, so there could be security concerns that are raised in the US over this move.
The grouping now has 5 of the top 10 oil-producing countries. How do you think this is going to play out in terms of oil production and prices versus demand?
I mean, I think, of course, when you have oil producers and oil importers on the same forum, they no doubt will discuss oil. But, it really is still going to be OPEC that is the forum that sets pricing and quotas. Of course, China will want to have some input into that process, and that could come about through the BRICS forum. But I don't think it's going to replace OPEC to any degree, really.
It is clear that the hope for China and others in the group is that this new BRICS will turn the world order as it is to upside down. Do you think that is at all possible?
I think that's many years in the future, if at all. I mean, I think that certainly, I mean, some things are moving slowly, like edging out of the dollar very slowly. But things like the institutions such as the IMF and the World Bank, yes, the BRICS does have the new development bank, but this is on a much smaller scale than the existing institutions. So it's a long way from being a bloc that can really challenge G7 and the existing global financial institutions.
Really good to speak to you, John Harrison, Managing Director of Emerging Market Macro Strategy at Global Data TS Lombard. Thank you.
Thank you.
Sri Lanka's government says the country's economy is recovering following a $3 billion loan from the International Monetary Fund. But the cost of living there is still high. Many poor communities are struggling. Manel Fernandez has more from Colombo.
Mercy Pereira is struggling to keep the home fires burning. Her electricity has been disconnected because she couldn't pay her bill, which has increased in recent months. When Al Jazeera met her last year, she was supplying food to a local eatery, earning barely enough to make ends meet. Now,
I had to give up selling string hoppers. Gas, kerosene, flour and a lot of prices increased, so I couldn't manage. Now I provide meals to some students who are lodging nearby. I'm managing with great difficulty.
Mercy's plight is common among hundreds of thousands of Sri Lankans, not just the poorest.
1 year on, the government says things are on the mend. There are no more queues, inflation has fallen and worker remittances have increased. But many people here are still struggling to earn a living.
The situation has been a challenge for those running the government social welfare program, which has tried to cushion those worst affected.
When we compare with the last 5 years, you know that we had a safety net program for the poor and poorest people, only about 1.7 or 2 million, right? But this time, we called the application, we received 3.7 million.
President Ranil Wickremesinghe and his government say they have turned the economy around. The recovery plan has seen inflation, which peaked at 65% last year, falling to single digits for the first time since 2021. But poverty has increased to 25% and a large number of people have lost their jobs. President Ranil Wickremesinghe says primary challenges now are the lack of government revenue and a trade imbalance.
We can't keep taking loans to cover these two. After the current debt restructuring, the same problem will recur from 2025. And after a maximum of 10 years, we'll be back at the same problem. We have to get over this and not get stuck in it. To do so, we have to increase our GDP.
Analysts say things have been stabilized. but warn there is much more that needs to be done before Sri Lanka is on the road to recovery.
We have stopped things getting worse at the speed they were, but have we turned around? I think, Minette, we haven't yet turned around, because turning the corner would mean that we have stopped reducing our GDP, but up to the second quarter of this year, GDP kept contracting. That means we also were losing jobs in the economy month on month.
Financial indicators don't mean much to Mercy and so many like her. Their concern is making ends meet. Minna Fernandez for Counting the Cost.
And that is our show for this week. Get in touch with us on X, formerly known as Twitter, at Marlene Saeed. Do use the hashtag AJCTC when you do. Or, of course, you can drop us an email. countingthecost@aljazeera.net is our address. And there's more for you online at aljazeera.com/CTC. That will take you straight to our page, which has lots of reports, links, and entire episodes for you to catch up on. That's it for this edition of Counting the Cost. I'm Marlene Saeed. From the whole team, thanks for joining us. The news on Al Jazeera coming up next.